In this video, guys, I want to explore what is short selling. A short answer and a long answer. Stay tuned. Hey guys, warm welcome to you. Alright, so one of the basics to understand with trading is short selling. We've got long, we've got short. Long means you're buying something with the expectation of it to go higher. The higher it goes, the more money you make. If it goes lower, you lose money. The flip side, and something that active traders can do with the right vehicle, CFD, spread bet, futures contract, some shares, options slightly different, but there's some vehicles that allow you to do this, which is to speculate on that asset going lower. In other words, hey, I think this asset's going lower, I'm going to sell this short. You will make money then when that asset drops. This is a key tool that active traders use, so you don't just force into buying things. Now, some controversy around short selling, people saying you wanted the company to fail and all this type of stuff. I don't buy that. I don't believe that. You know, in fact, short sellers do expose sometimes some financial fraud. You know, some of the bigger short selling companies out there that specialize in research on the short side, this is a different world to us as retail traders, but they'll be digging into the accounts and all this kind of stuff, and you know, their job is to expose stuff and to kind of say, hey, there's something wrong with that. That's not right. That valuation's too high. This doesn't make sense. And to shine a light on things. I think they provide a good service. But from our perspective as retail traders, you know, we're holding for maybe an hour, 15 minutes, a couple of days, a couple of months. The stocks and assets are going to go up and down, up and down. And just having that ability to be able to capitalize and profit from down moves is an essential part of trading for us. So what is it and how does it work? The first thing is that the short answer is literally this. You will go to a broker, a CFD broker, a futures broker, a spread betting broker, even a share dealing broker. Some of them in the US is a little bit easier to do, and you will just say, hey, I want to sell this short. Now there's some restrictions, there are some things sometimes you can and can't do, but effectively they just go, yeah, okay, that means you've got a negative position in that asset, and for every move, every cent it goes lower, you're making money. For every cent it goes higher, you're losing money. Very simply put, it's just a bet in the direction, a trade in the direction. Now, taking it more complicated, if in simple terms is, if you're trading via a CFD or a spread bet. Spread bet's a down bet. You're basically betting on the movement of price going lower. It's for you UK guys out there. CFD, similar, it's a contract for difference. You're exchanging a contract and saying, hey, I think this is going lower. I'll pay you the difference between the price I sell it at now and the price I buy it back at. And if it's lower, you can pay me. If it's higher, I'll pay you. A futures contract, you're selling that futures contract into the exchange and you've got to buy that back. And your position would be minus, say you sold one contract -1, and you need to go back to flat. If it goes lower and lower and lower and you buy it back, you're going to make money. If it goes higher, you're going to lose money. Now, stock is slightly different, where we get into this little bit of complex scenario. If you just wrap your head around the fact that shorting is literally speculating on an asset moving lower, that's probably enough. You can probably end this video now and go, thanks very much. I understand it. I know why it works and how to use it potentially. And you can probably go down rabbit holes of different strategies and stuff. But if you want to kind of look at the nuances, I'll explain that to you now. So, with a stock, from a stock perspective, is slightly different, because this is where people go, how can I sell something I don't own? And that's the bit that gets people sometimes. And you don't really need to know that, but if you do, then hang on for the next couple of minutes. So I will go, right, I want to short sell this stock. This is what the kind of bigger funds would do, right? You and I can just go to a broker, hit short, and all this stuff is done automatically. Say spread bet, CFD, futures contract, fine, that's all easy. And most of the time for stocks as well, if it's easy to borrow, we'll get to that in a moment, you can sell it short, not a problem. But how does it work? What does borrow mean? And how can I kind of wrap this into people getting stuck short and short squeeze as well? I'll touch on that as well. So I might say, right, I think this company is well overvalued and I want to sell it short. Now, I go to my broker and I say, hey, I want to sell this. And by the way, this is all seamless now and very, very quick, but I'm breaking it down step by step. You go, hey, I want to sell this company short. And they say, yeah, sure, no problem. And they'll ring around, won't do this, but they'll ring around and go, hey, Mr. Pension Fund, can we take a couple of million shares, please, off your hands and borrow those for the time being? I know you're holding those for the next 10 years. We've got some short sellers who want to kind of trade these. And they go, fine. Because what happens is they they don't care. These people who are holding this stock for a long period of time do not care about the short-term fluctuations, aren't interested, couldn't care less. However, what they can do is say, yeah, you know what, we've got those shares, we're sitting on them for the next 20, 25 years as part of a big pension fund, we don't plan on selling them, whatever happens with this, we're just sitting on them, we're happy to loan them to you, but for a fee. And so all of a sudden it increases their return, right? They're looking to kind of make a few percentage points a year, whatever it is. By loaning out those shares, they make a little bit back. They say, yeah, sure. How much you need? Say, okay, well, I'd like 100,000 shares. They're like, okay, fine. This will cost you X% per day that you have these shares. And we can call them back at any point in time with 24 hours notice. Is that a deal? Yes, that's a deal. And so they come in, the broker says fine, the broker's doing this on scale, and then comes to the individual trader like me and says, hey, go, you can borrow those shares. It'll cost you X% per day to have those shares on loan, obviously making a little bit extra on the top of that. And by the way, if we say want them back, we will force you to liquidate that position because the person who owns those shares will want them back. That's key. That's how we get these short squeezes. You can probably start to think what happens now. Now all of a sudden we go, right, okay, that's me sitting there, this is far too high, I want to short it. We go and I borrow the shares. Now all of a sudden I've borrowed these shares, 100,000 shares say, and I go, okay, I've got this 100,000 shares, what do I do? I'm going to sell those into the market. I borrowed them, so this is pen is them, I borrowed them, I sell that pen, I'm like, okay, I've taken, let's say £1 a share each, I've got £100,000, $100,000 in my hand. Great, I've got $100,000, I've got no shares, I owe that guy 100,000 shares, I've got $100,000 and I'm sitting here. I'm like, okay, I pay a little bit, or I put it to one side and have to pay each day, generally speaking. Or I'm depending on the broker situation, I'm paying a little bit each day to borrow these shares. And the harder they are to borrow, the more expensive the charges. And you can get something ridiculous, like 100% a year for some things when they're in demand. There's a massive demand there, supply demand, right? They go, well, everyone wants to borrow my shares. I'm going to really charge you a lot to borrow this. And so that becomes quite lucrative for them. But anyway, by the by, so I'm paying and paying and paying. Let's say now these shares go lower and lower and lower, and they go to 50 cents a share, and I'm right and go, woohoo, I was right, I thought it was too high, down it comes. I now need to, what? Buy back those shares. So I go into the market and I go, oh, I'd like 100,000 shares for 50 cents a share. I go, great, that cost me £50,000, $50,000, pounds, whatever we're talking about. Fantastic. I have now had £100,000. Let's keep pounds, I'm freaking around. £100,000, okay? Because I sold the shares that I borrowed, but I had to give those shares back. Got £100,000 here. I now buy back those shares for £50,000. I have £50,000 left and those shares. I pay the shares back to the broker who pays them back to the borrower with his little bit of charge each day and say, thank you very much. There's your 100,000 shares back. And here's your cost for borrowing those shares. Appreciate your business. Let's do business again sometime. My speculation and my directional bet has been right, has proved correct, because I've made 50,000 on that. Those shares have halved in value. I sold them a pound a share. They've gone down to 50p a share, 50 cents a share. Great, I've made the money on that. Fine, that's how it works. Now, if I'm wrong and that goes higher and higher and higher and higher, I'm gonna have to buy those shares back. I went from £1 to, or £1 to £2, and I had to buy them back at £2. How much is it going to cost me to buy them back? I've got 100,000 because I sold them in there, but now I need to buy them back. I need to pay 200,000, so I have to pay the 100,000 I've got plus my own 100,000 to get the shares back to give back to the guy. And I've also got to pay a fee for borrowing them. Now, this all goes on behind the scenes. There's no need to kind of understand this, but it's there. Now, what is interesting is how we get short squeezes, right? Because let's say I'm wrong, and let's say I thought this was too high here, and I was like, "Ooh, this is too high," and it kept going and going. This was 100, and it went to 200, and it went to 400, and it went to 800. And I know that scale's wrong, but you get, and I'm like, oh my gosh! All of a sudden now, I'm stuck because I have to cover this position and buy those back. And this guy, who's quite shrewd as well, who's loaned me those shares, might say, I want them back now. Because I might have big, deep pockets, right? I might have several billion under management, and I can sit through this. I might sell some more short. I'm like, you know what? Doesn't matter. Because I know this, I've got a good idea this thing's going down to 10 cents a share, 10p a share. Fine, I'll sit through this. But if he recalls his shares and says, I want them back, all of a sudden you've got this perfect storm, right? You've got this perfect storm of price going higher, higher, higher from buying, and now he's saying, shares now, shares, I have to become a forced buyer to cover this position that's painful, and there's people who are shorting who will also be in pain, who will be voluntarily covering the position. It creates that short squeeze that we hear about, which is the price like spiking higher, 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 higher. Okay, I have to buy them back. He wants his shares back. I give him his shares back. I give him the money thingy. I lose a load of money. So this is kind of the intricacies of short selling. The short answer is it's just a downside bet. It's all done for you. If you can borrow the stock, if it's a shortable instrument, it's done at a broker level, it's fine. You got to pay a little cost sometimes. Fine, easy way to work out. But on a more kind of intricate level, the nuances is exactly this. You borrow the shares, you sell the shares, you buy back the shares, you give back the shares, you pay a little bit, and hopefully you make some money if you're on the right side of the deal. You can see how this can get pretty dangerous pretty quick. Take care. See you next one. Bye-bye.